Welcome back, everyone. This is a brief update on news from the oil market. WTI prices moved in a sideways motion in the past days after data regarding the market indicates mixed signals. Some of the most important oil market drivers are detailed in this report, giving traders the most important highlights to be aware of when trading the oil market. Starting with our weekly readings. According to the US API that was released in the previous days, a drawdown of minus 4.3 million barrels was seen for the week ending Friday the 24th of January. On the contrary, yesterday the EIA weekly reading delivered a surplus of plus 3.55 million barrels, which consequently forced oil prices to drop upon release. Oil traders' response to the news could be considered as reasonable due to the fact that surplus came as a surprise when analysts expected a drawdown. Yesterday, reports surfaced implying that further military attacks had taken place in the Middle East. The Yemen-Iran-aligned Houthi movement attacked Saudi Aramco facilities with rockets and drones. However, according to Wall Street Journal, Saudi Arabia's air defense forces managed to prevent the worst from happening by destroying the incoming rockets. This is the second time that Aramco's facilities become a target in the past months. Back in September 2019, bombings had taken place once again on Aramco sites, which created a minor spike in oil prices. It seems that the terrorists aim for oil facilities as they have a significant impact on oil prices, causing them to rise steeply, but most importantly, have a negative impact on production in Saudi Arabia. Oil production is a rather sensitive sector for the kingdom's economy, and terrorists use this to their advantage. Further attacks on such sites have the potential of creating big swings in oil prices, and so the matter is of great importance to oil traders. Moreover, in the recent weeks, the IMF lowered its expectations on economic growth in Saudi Arabia from previous 2.2% to 1.9%. The decrease came after the IMF said that cutting oil production could reduce the size of growth within the economy. Even so, the kingdom stated previously it planned to reduce the country's economic dependence on hydrocarbon with diversification methods. On another front, some reports indicate that OPEC has major plans to keep its oil production cuts in place until June 2020. As we have noted in the past, it might be OPEC's plan to offset increasing oil production taking place in the US currently. The report does not only make reference to extending the production cuts, but it also deepening compliance of the cuts, possibly in order to deliver the maximum effect on the commodities price. The main target that OPEC Plus group has had so far were to bring stability to the commodities price by removing major swings. Also, having in mind that the US has big plans to increase oil production even more, OPEC Plus may have to restrain production equally but protect its current market oil share. In any case, Saudi Energy Minister Prince bin Salman, in one of his reports in the previous week, said all options will be considered when OPEC Plus meets in Vienna in March. As a conclusion, a very interesting report from the US Energy Information Administration yesterday found that oil production growth is outpacing the growth of consumption. This effect may persist throughout 2020, as in the US production is forecasted to increase further. This, in our opinion, remains the main driver behind oil prices dropping at the moment. For more information and trading ideas, you can visit our webpage, follow us on Twitter, like us on Facebook, or subscribe to our YouTube channel. This is Angelos Zitis from IronFX, wishing you solid trading.